Chinese government bond yields are at multi-decade lows after a recent powerful bond rally. There's at least a mini rally developing in treasuries and other government bonds around the world after an equally powerful rally at the end of last year. And these signals are incredibly important. They're more important than they have ever been in the past. But why is that the case? Well, bond yields have always been useful, but what has happened is that pure money signals have been taken away from us, leaving us without that critical insight. And it's insight not just about money supply. Monetary conditions would tell us a lot of highly useful and crucial information as to the state of the entire world. But we don't have that, and we haven't had it for a very long time. And Alan Greenspan, throughout the 1990s, tried to tell people that we don't have that insight. And so not only was the Fed flying blind, so was everyone else, because everyone else came to lean on the Fed exclusively, which made him a little bit uncomfortable. As he said in 1997, increasingly since 1982, we have been setting the funds rate directly in response to a wide variety of factors and forecasts. We recognize that in fixing the short-term rate, we lose much of the information on the balance of money supply and demand that changing market rates afford. But for the moment, we see no alternative. In the current state of our knowledge, money demand has become too difficult to predict. And it's money demand, money supply. That information isn't just about the monetary system or strictly monetary conditions. It's about the whole state of the world, and in maybe the purest sense of all of these economic and financial factors coming into one convenient place. But since the Eurodollar evolution in the 70s and 80s, as Greenspan was saying, the Fed had to change its entire operations because it couldn't keep up with the monetary system. Not only did that leave monetary policy as more and more non-monetary policy, it leaves us with fewer direct signals on this critical space. In lieu of all that, we start to depend upon bond yields. And that's what makes bond yields these days more and more important. But understanding why that is, we have to understand how we got to this point. And so we'll go back to Greenspan again, but this is in 1999. In February 1999, the FOMC was discussing this very phenomena about how they were losing track of the monetary system and how important that was. At the time, the Federal Reserve was still obligated to maintain money supply forecasts because even Congress, after the experience of the Great Inflation, realized this money business is incredibly important. And not just about inflation, but especially inflation of the 1970s. And so they told the Fed, every year you have to come up to Congress and tell us all about the money supply targets that you're going to maintain and try to keep up with. That's really where the Humphrey Hawkins testimonies came from. It's about the politicians in Congress understanding that monetary fundamentals are incredibly important for the wider economic system, not to mention financial markets too. And so the Fed was obligated to maintain money supply targets that by the 1990s knew were impossible. And in 1999, once again debating the money supply targets for that year, they came to another realization that, look, we just have no information, no insight. The M's are all corrupted. We'll start out with Don Cohn, who said, I think that by 1991, we were beginning to get some sense of what was going on. Specifically, that banks were getting into the mutual fund business. Mutual funds in particular were much more freely available to households, and households were diversifying their portfolios out of deposits. Again, the proliferation of financial products. It began in the 60s and 70s, even before then, but really the 60s and 70s and the 80s especially. Money market funds, the rise of non-banks such as mutual funds. And we'll come back to this in just a moment. Continuing, Mr. Cohn. If you look back at our forecasts in 1990 and 1991, that development caught us somewhat by surprise. It caught them completely by surprise. But toward the end of 1991 and in 1992, we were doing a better job of forecasting. And Greenspan butted in saying, yeah, but you were putting in add factors, fudge factors. And Cohn said, yes, because we knew that the world had changed. So the old equations weren't working. And they never really got them working, even with their fudge factors. As Greenspan would say in 2000, the proliferation of products was just too extraordinary. As he admitted in February 1999, I must say that I have not changed my view that inflation is fundamentally a monetary phenomenon, because it is. But I am becoming far more skeptical that we can define a proxy that actually captures what money is, either in terms of transaction balances or those elements in the economic decision-making process which represent money. We are struggling here. I think we have to be careful not to assume by definition that M1, M2, or M3 is, or anything is money. They are all proxies for the underlying conceptual variable that we all employ in our generic evaluation of the impact of money on the economy. Now, what this suggests to me is that money is hiding itself very well. And that has enormous implications, especially, as I said, for an economic and financial system that grew up in the 80s and 90s in the shadow of the Eurodollar system without really realizing it, told repeatedly to depend upon these folks at the Federal Reserve for all of the monetary conditions and maintaining them and information about them. When in private and occasionally in public, monetary authorities were saying, we have no clue here. Money is hiding itself. We don't really know what's going on. Instead, we're going to move an interest rate target around the Fed funds rate target and hope that it all just works out. But from an informational perspective, what are you actually looking at when you look at short-term interest rates? You're looking at nothing more than what the Federal Reserve is doing. In the same way as you look at the Fed's bank reserve balance is nothing more, it's not the amount of money in the economy, it's nothing more than reflection of what policymakers are doing. So the monetary signals that we have, whether in the form of bank reserves or federal funds targets and other forms of interest rate targets around the rest of the world, they're just reflections of policymakers' opinions. Nothing more useful than that. They certainly aren't monetary, especially since policymakers, as we continue to see in 2024, use macro aggregates as their inputs and evaluation standards for all of their non-money policies. That's what the FOMC does. And it leaves us to either fully depend upon policymakers or go looking in other places for useful information in case you do realize how flawed the analysis is at these central banks, how little they understand the monetary system, and how important that all really is. You would think, though, that after everything that has happened over the last 25 years since this conversation took place, authorities and regulators and interested parties, politicians, governments around the world would have rectified this blind spot, especially in the wake of the monetary crisis, the global monetary crisis that struck in August 2007 and 2008 and into 2009, that defied central banks' best monetary efforts to alleviate the problem and to really get the system back on track, to act the traditional central bank as lender of last resort. That didn't happen. One reason why they call it a financial crisis and not correctly a monetary crisis. So you would think that at the very least, in the close aftermath of that absolute disaster that cost the global economy enormously, a bill to which we're still paying for today, somebody would have said, okay, let's take a look at this money business. Yes, we know M1, M2, M3, those are all garbage. They don't accurately reflect the monetary system as it is. We don't really know how to forecast money demand because the money that people use is constantly changing. Sometimes it's this, sometimes it's that, sometimes it's something that the Fed or central bankers have no idea what it actually is. That's what they were really saying. We can't forecast money demand because the money that the actual economic participants use is constantly changing. The proliferation of financial products. That stuff in the early 1990s, which sounds just regular stuff today, that was groundbreaking. Well, the system hasn't stopped. It continues to evolve. But you would think, again, somebody somewhere would have said, let's take a deeper look. And every time they do, they keep coming back to the same thing. We don't know. We have no idea. In June of 2020, the BIS, which is one of the few outlets around the world that actually has taken an interest, not just in the US monetary system, what the Fed didn't say in the 1990s was that this was a global affair. There was a global revolution in money, this is the Eurodollar system, that transformed systems, it transformed methodologies, mechanics, money supply, demand, all of it, transformed it all over the world. And so in June of 2020, basically admitting to the lack of progress in understanding the monetary system, the BIS wrote this: the complexity of the global US dollar funding markets, as well as certain data gaps, prevent the construction of an accurate and complete map of activity. International banking data provide a view into the activities of internationally active banks, but they often lack information on maturity and counterparty type. Data for transactions occurring between non-banks, financial or non-financial, in particular those transactions occurring outside the United States, are among the most opaque. So the Eurodollar revolution that was causing all sorts of problems in the 1990s and obviously caused a big problem in 2008, still don't have any good idea. This is 2020. And by the way, 2024, nothing much has changed. They even acknowledge all of the various parts and complexities and then say, I don't know, what do we do here? For example, although repo markets are more transparent now than before the GFC, it's not an F, it's an M, data gaps leave them relatively opaque. This is particularly true for activity among non-US entities that takes place outside the United States and activity outside the tri-party repo market in the United States. The repo market, which is a backbone, is as much about collateral as it is about currency or cash or whatever form of cash is being used at that particular moment in time. And so the very fundamental basis of this monetary system, however the formats are transacted inside of it, authorities still don't know what to make of them. And this is not a small oversight. Back to the BIS one more time. Moreover, cross-border and cross-sector linkages complicate efforts to monitor and manage the risk of a retrenchment in cross-border liquidity. The report suggests that more complete data collection could help reduce vulnerability, so why don't you do it? The report also identifies regulatory and structural policy options that could further reduce certain vulnerabilities. But basically, yeah, banks were a big problem before the G not FC, and actually were the very big reason for the G not FC. But in the shadow, as the banking sector has been hobbled by the lessons learned belatedly in that affair, it has given rise to non-banks, more proliferations of more products. I'll have more to say about these non-bank entities as we go forward because they are incredibly important to understand too. But for now, thinking about all of the potential factors that could harm the economy, create financial volatility, and authorities don't really know how it all fits together, especially things like international liquidity, repo markets, collateral, all the important information you would want to know if you are in a situation facing very clear and very strong risks, as we are facing in 2024. We've been talking about this for quite a long period of time, which for most people, for maybe a lot of people, they think, well, nothing bad has happened, nothing bad could happen. That sort of recency bias dominated in the middle 2000s too. And again, we're not saying that the world is going to end, that this is going to lead to an absolute utter crash. What we're saying is it would be really nice if we had more useful information about whether or not we can say for sure that is absolutely the case. This is where the information gap really comes in, being able to better define the risks that we obviously know that we are facing. We have a commercial real estate problem in the United States. We have a commercial real estate problem in Europe. We have a massive real estate problem in China. Wouldn't it be nice to have a real direct insight into monetary conditions, supply, demand, circulation, all of it? Because that would allow us to then at least better map out those risks that we are facing. But in lieu of all that, what we're left with is something like bond markets and bond curves and other esoteric curves that we talk about here at Eurodollar University, and, shameless plug here, in very great detail at Eurodollar University in our memberships and subscriptions. This is what we focus on and why we do so. But given the risk that we're facing in 2024, when bond markets start sending very clear and powerful signals, it's something you want to pay attention to. Now, the bond market is far from perfect. We get that out of the way. And it's complicated. It's not as pure of a signal like direct monetary knowledge would be. Yet it's useful. And the reason it's useful, well, in the words of Bill Poole back in 2007, it has inside information that we could never even dream of. The bond market is the monetary participants themselves trading in another medium. It's not a monetary medium necessarily, but it's a monetary adjacent medium that gives us, if not a pure signal, a useful signal nonetheless. As Poole said, I'll offer a hypothesis, which is that a number of people who are players in this market, like my contact at a large bank, are looking at news and saying that the proprietary inside information they have on what's going on leads them to believe that the overall economy has a soft tone to it that is not showing up in the data that we follow. And it doesn't have to be about the economy. It could be risks inside, say, the opaque commercial real estate market. If we start to see a big rally in bonds, it could be that hedging demand has gone way up. Now, the bond signal is just where we start. We want to corroborate that with other these esoteric curves, inside information directly from the monetary system itself, if not directly in the form of money supply, demand, and circulation. It is maybe as close as we could hope to in lieu of regulators and authorities doing their damn job, which they refuse to do after all these years later. So we depend upon bond market signals as the next best thing. As I mentioned at the opening, Chinese government bonds have made a big move over the last couple months, which the Chinese system is actually as opaque or nearly as opaque as the Eurodollar system is, because the Chinese have, over the last 15 years, undergone a radical revolution too. And there's many reasons for it we don't have time to get into here. One reason why, as I mentioned in a recent video, China's central bank has become, like its Western counterparts, being questioned over its transmission mechanism. And that's what the real transmission mechanism is about, is that we don't know how the monetary system works. So basically, central banks are just throwing darts and wondering if they can maybe influence some behavior. Well, as far as behavior goes in China, the big rally in its government bond market is the same thing as the big rally in government bond markets around the rest of the world. It's the monetary system and financial participants and economic participants looking at their own slice of information and saying, we don't like what's going on here, because lower bond yields increase demand for safety and liquidity. And when increased demand for safety and liquidity is evident in lower bond yields, it raises all sorts of uncomfortable questions about what must be happening in the economy, in the financial system, and in the shadows of money. Wouldn't it be nice to have that information? Huge rally in Chinese bond, another rally that seems to be forming in global government bonds, treasuries, European debt, German, all those types of things, which tells us that that's not a good set of circumstances. But where direct monetary knowledge would be useful is in more detailed understanding of what that actually means. So pay attention to bond yields, because we don't have any real idea about the monetary system, except as I use in the black hole analogy, how that black hole, the monetary system we can't see, impacts everything around it. That's what yield curves are telling us, even in China. They're not directly related to the monetary system, but they're close enough to it that you can get a sense of the overall picture. And the overall picture right now is one where bonds are rallying, even in the face of massive amounts of government bonds supplied, not just in treasuries, but, believe it or not, the Chinese government too. And yet demand for these instruments continues to be broad and deep, as that was the term we used the other day. How powerful is this Chinese bond rally? Well, the 10-year rate is now below the 1-year policy rate. So you could say now the Chinese curve is inverted too. That's a pretty strong message in China. But again, it's not just China, it's all over the place. In lieu of direct monetary knowledge, this is what we have to depend upon, especially in light of how positive all the official sources and all the official proclamations are, whether it be in China, how the economy supposedly turned a corner, or in the United States and Europe, which is supposed to be heading toward a soft landing. What does the monetary system think about it? Well, we don't know for sure, but we do have some idea. Government bonds, all about safety and liquidity. Well, gold is about at least just safety, and gold has had a record run here too. Check out what that's all about at the video link below. As always, I thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.